Hello and welcome to your daily note of March 13th, 2023. So, we need to cover Friday's information, which was the labor market update, but it seemed to have gotten overshadowed by the Silicon Valley Bank closure, and then the ripple effects that has now that Signature Bank has also failed and gone into FDIC takeover, and now there is rumors that First Republican is now struggling as well. I'm going to cover the labor market data, but let me first just give you kind of a brief overview of what we're seeing in the banking sector, how the Fed has responded over the weekend, and how that has made this murky economic situation even more uncertain as far as what the next policy action could possibly be. You probably don't need me to recap what has gone on in the Silicon Valley Bank saga. But what I will say is that late on Sunday, there was a joint statement made by the Treasury, the FDIC, and the Fed. So just real quickly, you can Google this at any point, but today we're taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. This step will ensure that U.S. banking systems continue to perform its vital roles of protecting depositors and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. After receiving a recommendation from the board of the FDIC and the Federal Reserve and consulting with the president, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank from Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting Monday, March the 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayers. We're also announcing similar systemic risk exceptions for Signature Bank, which again closed its doors by the state authorities late this weekend. And all depositors of this institution will be made whole as well. No losses will be borne by taxpayers. However, shareholders and certain unsecured debt holders will not be protected. Senior management has also been removed. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assignment on banks as required by law. Finally, the Federal Reserve Board on Sunday announced it will make available funding eligible to eligible depository institutions to help assure banks have the ability to meet the need of all depositors in the future. This is really interesting. I want to hit on what the Federal Reserve did and why it's creating uncertainty around policy. So the Fed has now decided to create additional funding through the creation of a new bank term funding program, offering loans of up to 1 year in length to banks, savings association, credit unions, and other eligible depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities, and other qualifying assets as collateral. These assets will be valued at par, and the BTFP will be an additional source of liquidity against high quality securities, eliminating an institution's needs to quickly sell those securities in times of stress. With approval of the Treasury Secretary, the Department of Treasury will make available up to $25 billion from the Exchange Stabilization Fund as a backstop for the BTFP. The Federal Reserve does not anticipate that it will be necessary to draw on these backstop funds. What is interesting, if you look at the term sheet, so the whole program is designed to provide liquidity to depositing funds, institutions, basically to help them avoid this interest rate risk. So a lot of the securities that banks are holding, they acquired during zero interest rate environments. What's happening now is interest rates are rising and people are taking money out of their bank accounts and into money market accounts. Banks are having to fund those outflows. How do they fund those outflows? Well, they have to sell securities if they don't have the cash on hand, and most of them don't. Selling the securities that they bought that are at 0% when they're now at 5 or 4%, that's selling those bonds or those securities at a loss to fund those outflows. those losses are accumulating and what are creating this unfortunate side effect that you're seeing here of bank closures. This is a side effect of raising interest rates as high as the Fed has. What the Fed's trying to do now is say, look, instead of selling those bonds to meet those deposits, we want to create a program where you give us the bonds as collateral. We'll give you cash in exchange on a short-term basis, because again, um, advances will be made available to eligible borrowers for only up to 1 calendar year. And then once that calendar year comes due, we being the Fed get to keep that bond. You have the cash or the liquidity that you need to fund your depositors, and then hopefully this will avoid any major malfunctioning of the banking sector. I think this is really interesting. It changes Fed policy from being a situation of, hey, we're trying to remove support and tighten on the banking sector, to now we're starting to provide support. This has made some very interesting moves in the interest rate environment as well, because you saw many people start to price in a 25 basis point increase, which has been the primary target for what the Fed's probably going to do next week. There, shortly after Jerome Powell met with Congress, everyone thought that he was going to increase 50 basis points, and you started to see that probability increased almost 40%. Now that this information has surfaced and the banking sector is under intense pressure, you now have an 18% chance that the Fed does nothing at all. There's actually no chance of easing at the current moment, but I guess it will depend on how the banking sector holds up this week and what data we get this week, because it's a huge data week. Not only are you going to get the inflation rate tomorrow, but you're going to get things like retail sales, building permits, housing starts, consumer confidence, as well as some of the regional survey data that we look at in the Philadelphia Fed and the New York State Empire Manufacturing Index. Um, Couple that with the employment report that came out last week that still showed a resilient employment report, a strong employment report, be it that we hired 311,000 jobs compared to the forecasted estimate of 210,000. We did see the labor force participation rate pick up, which is another healthy sign that the economy is improving somewhat. But the unemployment rate did tick higher, going from 3.4 to 3.6. What I think also helped in that employment report was average hourly earnings declined from the forecast of 4.7 down to 4.6. That's still greater than where it was at 4.4. And the weekly hours worked actually declined further from 34.7 to 34.5. So, this one definitely showed a cooling from the January red hot employment report, which also helps the Fed maybe to only do a quarter of a percent increase versus a full 50. Now, again, the complexity of the situation has changed, right? The fact that you're now having some bank funding issues, you're now having the Fed, the Treasury, and FDIC working in coordination together for multiple banks, not just one bank, Silicon Valley. It definitely, to me, paints a very uncertain picture. It's why the program has been created and invented here to backstop the financial sector and to backstop depositors, so that way you don't have a mass bank run. Again, this is not my area of expertise as far as analyzing banks. I am, versed in looking at total assets, total liabilities, and trying to focus on where the bank actually makes their money and where it ultimately comes from, but really how it plays into a factor of the overall health of the economy. And so it does look like there is some contagion risk. Just to give you an indication of that, I want to pull up First Republic Bank, which is in the news this morning, primarily because pre-market has them down about 61%. So you have another bank that's very well tied to Silicon Valley Bank. They are now under intense pressure as well. So it's definitely a situation where the problem is spreading, it's not to your large banks, it's not to JP Morgan or Bank of America or Citi or US Bank or Wells Fargo, but it is in these mid-sized regional banks and your smaller banks that it seems like this problem is occurring. And again, just to re-echo that problem, it's the situation where all of the securities these banks are holding are at extremely low interest rates. And if we're marking those to market, which at current regulations they have to, essentially the loss is being created because as depositors are getting better rates in money market funds and in CDs, they're taking money out of their bank, transitioning that money into something other than bank assets. The bank then has to sell those securities to help meet that claim, and they're selling them early or before maturity, and so yet they're not getting the full they're not getting the full maturity value, and that's resulting in losses for the banks. That's a lot. There's a lot going on. There's a lot of anxiety, and unfortunately, if you're on Twitter, it gives your head kind of a tailspin. What I will say is the employment report was stronger than expected, and it is truly overshadowed right now by what's going on in the banking sector. So let me hit on a couple things real quick. So the unemployment the non-farm payrolls employment rose by 311,000 in February, and the unemployment rate edged up to 3.6%. There was notable job gains that occurred in leisure and hospitality, retail trade, government, and healthcare, and there was a decline in information and in transportation and warehousing. If we come down, one of the things I want to look at is the number of unemployed persons was at 5.9 million, and that did edge higher there in February. That matches what we saw from the ADP report. It also matches some of the survey data that we've been seeing that employment is slowing down. It could also match a little bit about what we've been seeing in continued claims rising. So even though initial claims are still at extremely low levels and they finally ticked back up to about 211,000, we've been continuing to see continued claims continue to rise and stay elevated. And so this could also be an indication of that as well. Coming down a little bit further here, you can see the labor force participation rate with very little change at 62.5%, and the employment to population ratio held at 60.2. And both of these measures have shown very little change since the early pandemic, which was roughly 63.3% and 61.1%. So still improving, still trying to get these people back into the labor force here. Coming down a little bit here, I just want to highlight some of the jobs here. So leisure and hospitality adding 105, retail sales adding 50. Coming down, government increased by 46,000. Employment in professional and business services continued to trend up by 45,000, with a gain of 12,000 in management. Employment in professional services had increased on average by 35,000. The reason why I'm digging a little bit deeper into these, we actually saw in the JOLTS job openings and labor turnover that these job openings came down a lot, and then the construction job openings came down a lot. But yet you can see that in both categories in the employment report, they actually still had net hiring. So construction actually grew by 24,000, healthcare by 44, so forth and so on. Here's the job losses. The information tech industry lost 25,000 jobs. Transportation and warehousing lost 22,000 jobs. Here's your work week and average hourly earnings. Average hourly earnings actually rose by 8 cents or 0.2% to 33.09. Over the past 12 months, that average hourly earnings has increased by 4.6%. This is also creating still some wage price component to the inflation problem. We talked a little bit about that. The average work week for all employees on private non-farm payrolls edged down by 0.1 hours to 34.5 hours in February. And again, this is a reduction. If hours worked are slowing down, that means demand is slowing down, and that could continue to spill over in the employment report. So a softer employment report without this bank debacle here would tell me that the Fed was going to raise 25 basis points or 0.25%. With the bank debacle, I think you have to be considerate to maybe they don't raise at all. Maybe they just pause here. see if they can actually get through some of these bank issues that we're seeing here. Don't forget, Silicon Valley Bank was also directly tied to startups and venture capital and FTX and some of the crypto markets that have been under a lot of pressure as well. And so, in some ways, the Fed is really working through some of the excess that we saw in the previous cycles here. I'm not saying that it's not scary or it's not fearful, but their policies are working is probably what the best way I'm trying to say it is. What we did see in the market, I think, was really interesting. The sell-off in the sectors have brought things like the financials now to a point where they're not providing good risk-adjusted return. You now only have industrials and materials, which really match with the infrastructure bill. Um, this situation could actually make the debt ceiling conversation a little bit more difficult to swallow. It may actually push that debt ceiling higher, despite the fact that the Republicans may want to hold it hostage. There's sounds like there's going to be some funding that needs to be made here to provide some support, but yet still try to cool this inflation problem. Again, this is a really delicate situation as I'm seeing it here. Fixed income, you can see long dated treasuries really starting to provide great risk adjusted return. And that, I think, is a byproduct of the interest rates coming down so much. So, for instance, the 2 year went from just above 5% all the way down to 4.6. It's one of the sharpest moves lower that we've seen since 2008. And the same thing with the 10 year, going from 3.98 all the way back down to 3.7. These funding problems have not showed up in the volatility index yet, but I expect as the market opens, we might see these kind of creep a little bit higher and put some downward pressure on the market. This is the chart here that I always post at the bottom. I think leads to some of these problems as well. The Fed is still draining liquidity, right? And they're getting dangerously close to currency in circulation. When you account for the Treasury General account, the reverse repurchase agreements, there's only about a $300 billion difference right now. And if they're still going to continue to roll this off at $95 billion a month, they have until the summertime, basically, before they're going to reach the floor of the ample reserve policy that they're implementing, meaning that if they reduce further, then there's going to be less liquidity in the system than what's actually needed. And that can create these funding problems that we're seeing now. So, to me, I'm getting a little long winded here. I try to keep these to 15 minutes, but there's just so much going on, so much information to come out. And yet the clarity of the situation is going to be harder to navigate going forward. I think it still advocates for investors to remain defensive. I still think it advocates for this sideways consolidation that we've been calling of in the marketplace. Let me just real quickly just show you that through this chart here. Um, so these are things that I've been looking at for some time here. That hey, it looks like on balance, the market's been moving just somewhat sideways since August of last year. We are trading at the low end of the short cycle, which is in red there. But the gap that I see is between this 3,700 and this 4,200. And this is a very, very wide gap. And we're probably just going to trade within those two ranges as we get more clarity on how deep the recession is going to be and how the economy holds up in the face of this. Again, lots going on. I think, again, you remain defensive. Let's see what some of this data looks like. Let's see what the price action is today. Right now, I believe pre-market, when I looked this morning, it raced most of the gains as the leak of First Republican Bank has come out. So we'll see. Stick with us. If you have any questions at all on any of this, don't hesitate to leave us a comment below or shoot us an email. We'll be happy to answer that for you. We'll be back again tomorrow to give you an update and an estimate on what we think the inflation rate is going to be. And we're going to continue to follow the Fed's new funding program and how many banks actually tap this line. Now that we have this dynamic of depositors moving their cash to take advantage of these high rates and banks having to sell securities that unfortunately are at large losses here. With that, I thank you this morning. I hope everybody has a great Monday. Hope everybody has a great start to their week. If you have any questions at all, don't hesitate to reach out.